Okay, we are live. Hi, Cole.
Good afternoon. How are you, Kelly?
Good, thanks. How are you?
I'm doing great, thank you.
Good. So we are live here with Cole Sjoholm from Fairway Independent Mortgage. And I wanted to invite you on to talk a little bit about reverse mortgages. For those of you who haven't met me, I'm Kelly Maves. I'm with Next Home Virtual here in Grand Junction. I took a class with Cole last week. He taught a class on reverse mortgages, and it sort of blew my mind a lot because it's not the same reverse mortgage that has gotten a bad rap kind of in the 90s and early 2000s. So I just felt like it would be really beneficial for us to get on here and share some information about what are reverse mortgages, who can benefit from them, and kind of the cool thing about them is they're a little bit of a loophole, I think. So I'm going to let you kind of run with it. If you have questions, you can leave them in the comments and we can address them as we go, or we'll record it also so you can look at it later. I'm also going to post in the comments a little form that you can fill out if you're interested at some point in having a consultation, just to no obligation, just to get the facts, to talk about a reverse mortgage and what that could mean for you or your loved one. So I will let you hit it.
Perfect. Thank you so much, Kelly, and welcome everyone. Thanks for joining us today. So with reverse mortgages, I think there's probably more misconceptions or myths than there are actual facts known out there. So we appreciate your time being here today. We're going to definitely try and answer as many of those as we can, but we're also going to illustrate through some graphs and charts what a reverse mortgage can do for you and how it can benefit you financially. And this is regardless of your financial status. A lot of people think that a reverse mortgage is the loan of last resort. And really, if you're over that 62-year-old threshold, it should really be the first loan option that you're looking at as you move forward. So again, I'm with Fairway Independent Mortgage. My office is located down on Main Street here in Grand Junction, and I'm licensed to originate loans throughout the state of Colorado. So, what is your opinion about reverse mortgages? And, if you'd like to add a comment in the chat, please feel free to do that. But a lot of people, again, they think that they're this loan of last resort. And today we're going to try and change your opinion about that. Fairway is one of the largest reverse mortgage originators in the country. We have an entire division that's all that we do is originate reverse mortgages. Me as a loan officer, I originate both traditional or forward mortgages as well as reverse mortgages. And I've been originating reverse mortgages for over 10 years. And I can promise you the amount of training and support that we have at Fairway is second to none in the business. And we want to make sure that you understand what a reverse mortgage is and how it can benefit you. Most recent data available publicly is that we are number 4 with reverse mortgages for purchase. And that's myth number 1. A lot of people don't realize that you can actually purchase a different residence using a reverse mortgage tool or reverse mortgage loan. And you certainly can do that. And then in addition, of course, you can always refinance your existing home. And that's whether you have an existing mortgage balance that you want to no longer make payments on, or if you own your house free and clear, you can refinance into a reverse mortgage loan. So some basic requirements for the reverse mortgage program. Every borrower has to be 62 years or older. That doesn't mean that if one person that's an owner of the house is under 62, that you're not eligible. There was some changes back in 2018 that allowed for you to take advantage of the reverse mortgage program as long as one of you is over 62 years of age or older. If both of you are over 62 years of age and you both want to be on the loan, we will use the age of the youngest borrower to determine the principal limit factor. We're going to talk more about what that terminology means. One of the scariest things about reverse mortgages is that terminology. It's not that it's actually scary, but it's just some different terminology than what you've been accustomed to with other loan programs. FHA, or the home has to be FHA qualified, And really all that means is that there can't be any chipped or peeling paint, broken windows. The roof and foundation have to be in acceptable condition to qualify for a reverse mortgage loan. If you have an existing house and it doesn't meet those conditions, we can actually help finance those improvements during the reverse mortgage process. So after closing, we actually make those repairs to bring your house to that acceptable condition, which should give you some additional peace of mind as well. The next one is a little bit of a misnomer, but generally speaking, this has to be your primary residence. And what that generally means is that you live in the home for more than 6 months out of the year, or it's the residence that you claim as your primary residence for taxes. You can only have one primary residence, so it's where you have your cars registered, where you have your voter registration, things like that. It doesn't mean that you can't go around and travel the world for 9 months out of the year or anything like that. Generally speaking, it just has to be your primary residence. The great thing about reverse mortgages is it has no effect on your Social Security or Medicare benefits. Again, we're not able to provide tax information or tax advice. However, has no effect on those, meaning that you can access your equity in your house to supplement or replace your income sources without any tax consequences. If you're on Medicaid, there is certainly ways to structure the reverse mortgage program that it doesn't affect your eligibility for those types of programs. But just note that there may be some effects that we need to discuss if you are on Medicaid. So one of the common misconceptions is that when you get a reverse mortgage, you give up ownership or you place your home in the bank's name for a title. And that's actually not true. A reverse mortgage is just like any other loans. You completely retain ownership of the house and the house remains in your name. We just file a lien or a loan against the property just like any other loan program. You can sell the house, you can buy a different property, anything like that. Just in those events, the reverse mortgage would get paid off like any other loan. There are some basic credit and income qualifications for a reverse mortgage, but they are very greatly reduced from a traditional loan program. We just need to make sure that you're able to pay property charges, meaning your homeowner's insurance, property taxes, HOA dues, and any other obligations that might show up on a credit report.
So Cole, can I interrupt for just a minute?
Yeah, please do.
When you have somebody who's coming in and they have substantial equity in their home currently, they're on a fixed income right now. What does that look like on the practicality on the qualification side for them when they come in to sit down with you?
Sure. Generally speaking, they haven't, lost their house to foreclosure, so they're making those payments somehow through other means. All we're really looking at is, do they have the ability to make those payments, or will the reverse mortgage also generate enough additional income for them to make those payments going forward? So it's a very logical type equation. If we're able to, they have other debts that they've accumulated, credit cards, home equity lines of credit, auto loans. Can we pay those off with a reverse mortgage and eliminate those payments for them going forward? So it's really meant to be a very flexible way for them to continue retirement comfortably without outliving their means. Does that make sense?
Yeah.
So the biggest, benefit for a reverse mortgage is that it's a non-recourse loan, and there's no monthly payments required for principal and interest. There's still, again, the borrowers are required to pay for maintenance, taxes, insurance, as long as they're occupying the home. But other than that, there's no required payments. I'm sorry, my slide deck went the opposite direction. So the only time that repayment is required is when the last living borrower permanently leaves the home, or if you as the borrower choose to sell the property. Other than that, you can never owe more than what your house is worth with an FHA insured reverse mortgage. meaning that if property values were to decrease and your loan balance is increasing because you haven't been making any payments, there's actually mortgage insurance that's included in the loan program that makes sure that you or your heirs are never left with a liability, which is pretty incredible. It gives you great peace of mind. Likewise, and important to understand is if you go to sell your house or your estate goes to sell your house, they still keep all remaining equity in the house, just like they would for any other mortgage program. The difference is that you're not making payments every month, or you may choose not to make payments every month. So the balance on the loan is going to be increasing. But the way the reverse mortgage program is structured is that typically your home value is increasing at a faster pace than what the mortgage balance is increasing. So every month or year that you're holding your house, the equity on the house is still increasing at a faster pace than what the loan balance is increasing. So it's a great way for you to do something with your money now, whether that's giving that to your heirs or your estate while you're living, or you can, in addition to the amount of equity that they still have when you pass and they go to sell the house. The really cool thing about it is if you're going to purchase a new house, and let's say you're required to make a 50% down payment based off of your age, if you were going to pay cash for that new house, you can do a lot of great things with those in retirement, with the additional 50% that you're not bringing to the table as a down payment, like you were paying, cash for the house completely. The misconception is that a free and clear house is actually safer than a reverse mortgage program. When we get through some of these slides, we're actually going to show you how it's beneficial to have a reverse mortgage versus a free and clear house, which is mind-blowing for a lot of people. But as we start looking at individual numbers in your case, we can explain how that's beneficial. So again, just some misconceptions that are out there. Number one, the bank takes the house or ownership is given up. We've already talked about that briefly, but it's really important to understand that you always retain ownership of the house. You can choose to sell it, move to a different house, move to an assisted living facility, whatever the case may be. Just the reverse mortgage loan has to be paid off. Other people think that they're too expensive to consider as a solution, or that they're really a bad thing. And we're going to show through some numbers here how that's not the case. I'm the most patient lender out there when you have a reverse mortgage. I'm going to get now and never require repayment until you no longer occupy the house as your primary residence, or until you pass away. So whether that's 2 years or 20 years or longer, I'm never going to require any repayment until one of those events happen, which is pretty incredible. The other misconception, again, that your kids are going to end up with a big problem or a big bill. And statistically speaking, that's not the case at all. They're going to continue to have large amounts of equity in the house. So you're not actually eating into their inheritance like many people think. The other misconception, again, that they're dangerous or risky. And again, in the past, prior to the early 2000s, when HUD stepped in and took over the program, they were a very different loan program than what they are today. But you now have the backing of the federal government. And again, there's no recourse. So there's no possible way for you or your estate to ever owe more money than what the house is worth, which is, again, pretty incredible. So a quick slide here on just home ownership and wealth. This box over here are people that are eligible for reverse mortgage loans. So again, in the 62 plus category. And obviously, for those of you on the call that are in that age range, you've accumulated an incredible amount of wealth over time through housing. And that's why Kelly and I love to be in the real estate arena. We love helping people create wealth. But as you know, that wealth doesn't do a lot of good for you unless you do something with your property. So unless you sell a house and cash out that equity, or you borrow against it through a home equity line of credit or a cash out refinance, there's not a lot of ways for you to access that until you pass away and you distribute that to your heirs. the reverse mortgage actually allows you to do that. The interesting statistic is that in the US, we have a little over $10 trillion of wealth. Seniors have $10 trillion of wealth in real estate, which if you added up the amount of gold mined through the history of civilization, it's almost the same exact amount of wealth that's been created. So if you go back and think about all of the gold that's been mined through history, seniors in the US have the same amount of wealth built up, which is absolutely incredible. Just some very quick numbers. If you're thinking about a reverse mortgage, whether you're purchasing or refinancing, the amount of equity that you would need or the amount of down payment that you would need to move into a reverse mortgage program. If you're right at the 62-year-old age bracket, you need about 60% down payment or 60% equity to be eligible for a reverse mortgage without needing to bring any additional cash to closing. As you move up in age, that number decreases. So at 72, it's around a 50% down payment. Around 82, it's about a 40% down payment. And those are not exact numbers. We need to run actual calculations based off of your dates of birth to generate that for you. But it's some quick numbers as you're thinking about doing this. If you'd like to contact me to run exact quotes, happy to do that. But those are just some general parameters for you. So this is kind of the fun slide because it starts, colors and numbers and all the good data, which I think Kelly and I both love data. So this slide, I think, speaks to us. But if you're looking at purchasing, let's say, a $300,000 house, and you're in the 62-year-old category, you're going to need about $175,000 worth of cash to do that. But again, once you invest that amount of money in your house, you're not required to make a payment going forward. You might be perfectly eligible or capable of making a mortgage payment on that $125,000 mortgage. But the reason that you necessarily wouldn't want to do that is you can choose to do other things with your money today, whether that's travel, help pay for your children's or grandchildren's education, home improvements, whatever the case may be, place in other investments that might be earning you a higher rate of return than the amount of interest that you'd be paying or that would be accruing on your reverse mortgage. Again, same number. If you're in the 70-year-old age bracket, it's about $158,400 of down payment money to eliminate your mortgage payment going forward. Different categories, a $500,000 house, which is becoming the normal or average price point here in Grand Junction and much of Colorado. If you're in that 70-year-old age bracket, you're bringing about $264,000 to closing down here in this category.
One of the things I wanted to touch on that I hadn't really thought of with a reverse mortgage, and on the real estate side of this, I know I see this fairly often where you have extended family, in-laws, et cetera, who maybe live outside of the state and they desire to live closer to their family, to their grandkids. And because of where they're moving from, their home values are less than what they are here. So in their minds, that's not an equitable sort of move for them to be able to come here to Western Colorado, where we do have an average price point of $425,000. So, they may live in Missouri and have their $250,000 house paid off. But also looking at $250,000 houses here feel really discouraged by what they can get for their money. And this provides kind of a workaround to that without them even having to make a house payment. One of the benefits to having your house free and clear, of course, is no house payment, but this is also a solution for that. And it allows them to be able to move closer to family and enjoy the last years of their lives and have family there to help them through that. So I love that idea for this.
Exactly. And, we have so much great healthcare here in the Grand Valley that, that's another reason that people are moving here. Our great VA hospitals recognized nationally as one of the top hospitals. So we see all sorts of different reasons where people are wanting to move to Western Colorado and they either can't or don't think that they can because they're not aware of the programs that are available. So when you have equity in your house and you're looking at refinancing it, or if you're thinking about buying paying cash for a house that you're going to purchase, the reverse mortgage has some different options for you when it comes to how to harvest that equity out of your house. The most common is number 2, a line of credit option, where again, it's a non-recourse line of credit. You can borrow against that, and if the housing market decreases, you can literally take money from your house that doesn't exist, because the calculations for a reverse mortgage are guaranteed at origination, and that can never be taken away from you. Whereas if you go out and you buy your house for X amount and you get a home equity line of credit, if property values decrease, there's all sorts of language in your home equity line of credit loan agreement that allows the bank to call that line of credit due and to not honor that amount, whether or not you've made payments or not, or whether or not you have the ability to make payments. Market conditions allow financial institutions to either exit that business completely or eliminate your line of credit. Where with a reverse mortgage, that's not possible. They're not able to do that. There's also a guaranteed growth, which means that the government assumes that houses are going to appreciate, currently at 4% per year going forward. So the unused portion of your reverse mortgage line of credit actually increases every year at a fixed amount. So again, if property values are increasing much faster than that, there's ways that you can access a higher amount through a refinance of a reverse mortgage. But if property values decrease or stay steady, your line of credit with a reverse mortgage is going to continue to grow, which gives you access to more capital than what the market may normally allow.
And it's technically an annuity, right?
Go ahead, Kelly. I'm sorry.
It's technically an annuity, I believe, right?
Right. I mean, it's set up very similar to that mindset or that thought process about how the calculations work. So exactly, it's a very powerful financial planning tool when you get to look at your exact situation. Other ways that you can access the money, you can get a lump sum at closing, and just if you know that you need $50,000 to do some home improvements and things like that, but you don't want to make payments on that money going forward, we can certainly do that. Or if you know that you need X number of dollars per month until you turn 70 and start accessing Social Security, we can help bridge those other financial tools that you have available. Like you might have a 401k or other retirement account that when you start taking money out of that, you're going to have to start paying taxes because that's a taxable source of income. If you have equity in your house, you can actually delay paying federal taxes if you want by accessing the amount of equity that you have and drawing that as your quote unquote income source, which is a non-taxable source of income for you. So again, you always need to talk to your tax advisor, but the equity in your house is not a taxable source of income, which is pretty incredible. A lot of people also they'll stagger the amount of money that they pull out of their house through their reverse mortgage. And then the next year they have to take a distribution from their IRA because they're required to. So they'll stagger how that comes. So they only have to file taxes every other year or something like that.
That's a good way to do it. What does that look like for tax benefits for your heirs upon passing, estate tax, step-up basis, that sort of thing?
Sure. That's a question you definitely need to talk to your financial advisor about. However, when it comes to the equity out of the sale, the normal taxation, capital gain sort of things still apply. So there's no negative effect on that. But you could actually pull out all the money of equity of your house and you can gift it to them under IRS guidelines above that allowable amount, which I think is around $15,000 per year per person. And you could give them their inheritance while you're still alive and actually help them this way versus having to wait till you've passed. So if you're in a great financial position, but you want to start getting them money and helping them out without having to take a personal income tax hit, like let's say you had a large amount of money in your investment account and your kids need some help to buy their first house, you could take money out of your investment account, then becomes a taxable event for you. Where if you took money out of your reverse mortgage and passed that on to them, it's not taxable for you. And if you're following the IRS guidelines, it's not taxable for them also. So it's that win-win situation that we all love, avoiding paying taxes.
That's great. We always love that.
So we're just going to look at a few quick scenarios here, and then we're going to turn it back over for any questions and wrap this up. But in this case, Deborah is looking at purchasing a home for $600,000. She's looked into several loan options and the amount of money that she'd pay over the life of a 30-year loan. Of course, these don't include taxes, insurance, or maintenance costs. And same with the reverse mortgage, you're going to continue to pay those on your own too. But we're trying to show a comparison. So if she made a 20% down payment, the average number or average payment here, principal and interest, is about $23.61 a month. So over 30 years, she would have paid out $970,000 in payments. You can purchase the house for cash, and that would cost you $600,000. Or with a reverse mortgage, she would only have to spend about $327,000 of money over 30 years. And that's, again, $272,000 of that becomes a loan. But the reverse mortgage is actually the least expensive way to purchase that house if she's eligible for a reverse mortgage. The 20% down payment is the most expensive option. The reason that the reverse mortgage is less expensive than cash is you're getting a loan for part of the money, but you're not required to make a payment. So you're essentially saving this payment amount over here because you're not required to make the payment. And you can either, pass it on to your heirs while you're alive, you can stack it up in your savings or investment accounts, or you can continue to make a payment on your reverse mortgage. There's nothing that says that you can't do that. And that money becomes available to you in the form of a line of credit. So you can borrow in the future. And again, that's protected money because it's guaranteed to grow at 4% per year based off of that guaranteed line of credit growth that's currently attached to a reverse mortgage line of credit. So again, James and Mary here, they're both 65. They want to move to a newly constructed home to retire. However, the community that they're moving to is almost double in cost of their current house. So they could sell their house for $315,000. They could purchase a new house with a reverse mortgage up to about a $600,000 price point and still not have a mortgage payment. So again, Kelly kind of spoke to that scenario already, where you have someone that's moving from a less expensive area to a more expensive area, and they're doing that for whatever reasons they want, be around family, healthcare, better lifestyle, so on and so forth. But the reverse mortgage program allows them to almost double their buying power and still not have a mortgage payment. You also might have the scenario where you're in a much too large of a house and you need to right size your house. Your current house is worth $400,000, but it's multiple levels, or it's in an area that you don't necessarily love, and you can find a new house at a less expensive price point. So in this case, Cindy, who's 70, she's going to sell her house that she owns free and clear for $400,000. She's going to move into this $375,000 house. She could essentially almost pay for that entire house in cash after normal real estate fees and loan closing costs to sell the house. Or she could purchase the new house for $375,000. Because of her age, she only needs about $198,000 of that money for a reverse mortgage down payment, and she still doesn't have a mortgage payment going forward. But then that leaves her $202,000 in her pocket to do whatever she wants with, whether that's helping her grandkids with college, supplementing her retirement income, so on and so forth. I mean, the possibilities are endless. So she's actually giving herself a ton of financial flexibility because she's freeing up all the equity that she has built into her existing house and utilizing her reverse mortgage. Again, there's all sorts of reasons for moving in retirement. What studies have shown is that most people are moving in retirement because they want to be closer to family. Some people are moving because they want to reduce their home expenses. Healthcare is another top 5 reason, but marital status is a big opportunity or a reason that people are moving. So it's an opportunity to use a reverse mortgage because unfortunately, when you go through a divorce, a lot of times your assets are getting split between both parties. And you once had a house that you thought, you're going to live in for free and clear with your significant other. And then a change happens, whether, that's divorce, death, something like that. And you need to make a change. So a reverse mortgage can help both of those parties separate peacefully through that process and do what's right for their housing situation. So again, we use this word downsize carefully. Downsizing, it's a right sizing. A lot of people don't need their 5-bedroom house anymore on 2 acres. They want something that's more manageable, that fits their lifestyle better. And there's no reason to stay in a house that doesn't work for you if you can move into something different, whether that's more expensive, but you don't want a payment anymore, or whether it's changing the size to a less expensive house and keeping money in your pocket to do other things in retirement. The reverse mortgage program gives you that flexibility to do what you need. Let's skip that slide. Just want to cover this one very, very quickly because it's important to understand. This is how you win with a reverse mortgage program. You take out a reverse mortgage when you're 62, and let's say you pay cash for the house. So you have a line of credit that's available for $223,000. You don't borrow against that because you have other retirement sources. When you hit 89, your house is worth less than what that line of credit has grown to through guaranteed growth. So you and your estate can actually pull money out of the reverse mortgage program. And because of that guarantee that you or your estate are never going to owe the more money than what the house is worth through that federal protection of the mortgage insurance, you can actually access more than what your house is worth, and with no recourse to you or your estate. Essentially, it's a losing proposition for the federal government at that point when this happens.
I'm a big fan of that.
So this is where even if you have millions of dollars in the bank and you can afford to pay cash for a house, take out the reverse mortgage and let the line of credit grow, because there's a point of financial calculation that your financial planner can help you with, and I can help illustrate for you, where it's guaranteed that the line of credit will be more than what your house is worth, unless we see 20% appreciation every year like we've seen in the last few years, which is unlikely to continue.
Yeah. So, yeah, I'm glad you were going to talk about this because I wanted you to mention the 1 to 4 unit properties.
Yep.
I was surprised when we had our class last week that this is not only for a single family, single unit type property. So explain that.
Yep, that's going to be the last thing that I cover, and then we're going to turn it over for questions. But a reverse mortgage can be used to purchase a 1 to 4 unit property. You must live in one of those units if you're purchasing a multi-unit property, because again, a reverse mortgage is only eligible to be originated on your primary residence. It can be used to purchase double-wide manufactured homes that are built after June 15th of 1976, as long as you own the real estate or the land underneath it. Condos are also acceptable. Condos are underwritten a little bit differently because both you as the borrower and the homeowners association has to be approved. But if the condo association itself isn't fully approved, we do have the option to get an FHA spot approval, meaning that you and your 1 unit are approved for the reverse mortgage. PUDs or HOAs are completely acceptable. Townhouses are fine. And you can actually purchase a house in a living trust in every state other than Texas. Or if you're refinancing, and you have your house listed in a trust, we can definitely work within those parameters too. The 1 to 4 unit is really cool because if you have equity available to purchase a 1 to 4 unit property, you actually generate income from the other 1, 2, or 3 units that are part of the property. And that's all income to you. And because it's your primary residence, there's not a payment on the loan at all. So you're collecting monthly rents from those other units, and you're using that into your monthly cash flow, and you're not required to make a mortgage payment on the entire loan. So it's a really powerful way to enhance retirement income.
Oh yeah, let me tell you what I'm going to do with this when I turn 62. I'm going to do that. I'm going to buy a fourplex. I'm going to live in one side, rent out the other three, and use that passive income to purchase more investment property. So, I mean, it's a great program.
The other, other ideas is if you have your existing house free and clear, but you want to purchase a second home on a beach community or something like that, you can take out a reverse mortgage on your primary residence, and the proceeds from that can be used for anything. We don't dictate that it has to be used for home improvements or anything like that. If you want to go buy a condo in Florida or, property in Mexico or whatever the case may be, you can choose to do that. You're able to move that money around however you want. So it's a very powerful tool. So I'll wrap it up there and just open it up for any questions or other comments for you.
Yeah, let's see if we have any comments here. I don't see any active comments or questions right now. But I guess, the big things to hit on are if you're 62 or over, if you have substantial equity or full equity in your home, then this is a really great option for you. And I would highly advise, because it is a little bit, it's on the surface seems a little bit confusing. It's actually a very simple product. And we understand that because we're in the business, but sometimes it takes sitting down with folks to help them understand that, and certainly have your kids or grandkids come sit down with you too. I know that some of the feedback that I've gotten on reverse mortgages is they're hesitant to use the equity that they have in their home because they want to be able to gift that to their heirs someday. And what I would say is I personally can speak for myself when it comes to my parents. I would much rather, they're the ones who have worked their whole lives to get to where they're at. I would much rather see them use their equity to be able to live a comfortable life for the remainder of their life, whatever that looks like when it's all said and done. So I would encourage folks to reposition their thought process on that, because I think most people's heirs would be in that same boat.
And I mean, we can show you through this calculation if we actually generate a proposal for you, which again does not cost you anything other than about 30 minutes of your time. We can run through those numbers, and I can show you, even if you stop making payments and you have the reverse mortgage, the likelihood of your estate having a significant amount of equity after 10, 15, 20 years is absolutely incredible. It actually increases at a faster rate than the amount of interest that's accruing on the loan.
Yeah, it's really almost foolproof. So I put the link in the comments. Again, it's just a jot form link. It's very simple information, but this allows us to get in contact with you if you're interested in what this may look like for you in your own specific situation. So Cole and I can work together on this. I'm happy to pull comps based on what your home is worth, how much equity you have in it, and then Cole will take it from there, and he will either work on the refinance for you so you have no house payment, or we can find the home that is right for you to age in place. And I think that's one thing that I've seen recently is our older clients are desiring to age in place. It's more comfortable in home. It's more comfortable to be able to be there. And it just provides for a happier place. So that's my encouragement. Cole, this product is awesome. I love it. And I'm a big fan. So
I can't wait to turn 62 either. I'm in the same boat. I mean,
right? I know this gives us something to look forward to other than creaking bones and things, which I'm already getting as I get older, which is sort of lame, but come on, 62.
Exactly. So again, appreciate your time today. I'll look forward to hearing from you. And again, it doesn't matter if you're not interested today. I think it's important that if you have any interest at all, or if you're over 62, you really need to look at this as a financial planning tool, whether you can make your mortgage payment or not. So give us an opportunity to run those proposals for you. There's no pressure at all. I just want you to have the information because it's absolutely a very powerful tool to move forward.
Yes, absolutely. So thank you, Cole. Thanks for spending some time with me today. And
thank you so much for having me. I appreciate it.
okay, have a good day.
Thanks.